Major recent earthquakes. At the beginning of 2010, there were two major earthquakes, 7.0 magnitude quake in Haiti in January and 8.8 magnitude quake in Chile in February. The Haiti quake killed over 220,000 people and caused $8 billion in damages, most of it uninsured. The child quake, though more powerful, was far less deadly as its epicenter was located in a region with relatively low population density, and because child's history of damaging quakes has led to strict building codes. The child quake and its associated tsunami caused over $4 million in insured losses and more than $20 billion in total damages, including insured and uninsured losses. According to Munich, it caused about 500 deaths. Financial and market conditions. Many forces affect the price, availability, and security of the insurance products. Some are external, such as the state of the economy, change in interest rates, and the stock market. Regulatory activity, the number and severity of natural disasters, growth in litigation, and rising medical costs. Other are internal, such as the level of competition. Fortunately, insurance companies run their business conservatively, as if every day might bring some new disaster. So despite current economic and financial conditions, the industry has been able to function normally. Unlike bank, insurers and are not highly leveraged. They generally do not borrow to make investment or to pay claims. They limit the amount of risk they assume to the capital they have on hand, and because they do not sell the risk they assume to another party, they have some skin in the game. They must underwrite carefully or suffer the consequences. The insurance industry is cyclical. Rates and profits fluctuate depending on the phase on the cycle. Particularly in commercial coverage, the profitability cycle may be somewhat different for different types of insurance. The cycle of the early and mid 1980s was among the most severe that the industry has experienced. That cycle centered on liability insurance. The most recent hard market began early in about 2001 and peaked in early 2004. The industry has been experiencing a soft market due to the poor economy. While there had been some indication that rates were flattening out, industry analysis expect the soft market to continue well into 2010. The insurance cycle. The property casualty insurance industry has exhibited cyclical behavior for many years. As far back as the 1920s, these cycles are characterized by periods of rising rates leading to increased profitability, following a period of solid but not spectacular rates of return. The industry enters a down phase where prices soften, supply of insurance becomes plentiful, and eventually profitability diminishes or vanishes completely. In the cycle's down phase, as results deteriorate, The basic ability of insurance companies to underwrite a new business, or for some companies even to renew some exciting policies, that can be impaired because the capital needed to support the underwriting of risk has been depleted through losses. Cycles vary in their severity. The insurance industry cycle is not unlike the cycle that occurs in agriculture. For example, in the wheat and beef markets, demand for the product in both industries is relatively stable and is relatively unresponsive to price change, while supply can vary from year to year. This means that when supply increases, lowering the price will not instantly clear the market of excess supply. If the price of auto insurance is cut in half, people will still buy only one policy, although they may increase the amount of coverage they purchase. In the 1950s and 1960s, cycle were regular with a 3-year period of soft pricing followed by a 3-year period of hard pricing in practically all lines of property casualty insurance. In the 1970s and 1980s, there were only two cycles, one mainly affecting auto insurance in the mid 1970s and the other in the mid 1980s, affecting commercial liability insurance. The commercial liability insurance cycle gave rise to the liability crisis when certain type of commercial liability coverage, such as insurance for daycare centers, municipalities, restore, and any establishment selling liquor became difficult to obtain. Since that time, with the expectation of the difficulty in obtaining medical malpractice insurance in the early part of the last decade, the insurance cycle has had less of an impact on the public. Flood insurance because of frequent flooding of the Mississippi River during the 1960s and the rising cost of taxpayer funded disaster relief for flood victims. In 1968, Congress created the National Flood Insurance Program NFIP. It has three mandates: to provide residential and commercial insurance coverage for flood damage, to improve floodplain management, and to develop maps of flood hazard zones. While the comprehensive section of an auto insurance policy covers flood damage to vehicles, there is no coverage for flooding in standard homeowners returns or commercial property insurance policies. It is available in a separate policy from the NFIP and from a few private insurers. Despite efforts to publicize this, many people exposed to the risk of floods still fail to purchase flood insurance. It was the widespread flooding associated with Hurricane Katrina in 2005 that drew attention to the NFIP and set in motion debate about how to improve it. So far, Congress has not taken steps to significantly revamp the program. Federal flood insurance is only available where local governments have adopted adequate floodplain management regulation for their floodplains areas as set but by NFIP. About 20,400 communities across the country participate in the program. NFIP coverage is also available outside of the high hazard areas. The NFIP law was amended in 1969 to provide coverage for mudslides and again in 1973. Until then, the purchase of flood insurance had been voluntary, with only about 1 million policies in force. The 1973 amendment put constraints on the use of federal funds in high-risk floodplains, a measure that was expected to lead almost universal flood coverage in these zones. The law prohibits lenders that are federally regulated, supervised, or insured by federal agencies from lending money on a property in a floodplain zone when a community is participating in the NFIP unless the property is covered by flood insurance. Legislation was enacted in 1994 to tighten enforcement of flood insurance requirements. Regulators can now fine banks with a pattern of failure to enforce the law, and lenders can purchase flood insurance on behalf of homeowners who fail to buy it themselves, then bill them for coverage. The law includes a provision that denies federal disaster aid to people who have been flooded twice and have failed to purchase insurance after the first flood. Buildings constructed in a floodplain after a community has met regulation must conform to elevation requirements when repair, reconstruction, or improvement to an older building equals or exceeds 50% of its market value. The structure must be updated to conform to current building codes. A 2007 NFIP study on the benefits of elevating buildings showed that due to significantly lower premiums, homeowners can usually recover the higher construction cost in less than 5 years for homes built in a velocity zone where the structure is likely to be subject to wave damage, and in 5 to 15 years in a standard flood zone. The Federal Emergency Management Agency (FEMA) estimates that buildings constructed to an FIP standard suffer about 80% less damage annually than those not built in